This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Welcome back to Business Breakdowns. Today, we are covering British American tobacco. My guest for today is Evan Tindall, co-founder and CIO of Bireme Capital. Now, regardless of your views on the actual product of tobacco, the market is one of the oldest in the world. Evan helps us cover how that tobacco market evolved, and we go way back in time, how the product itself has evolved from smoking pipes to cigarettes to what we're seeing today, the nicotine pouch market and all the craze around it. And we cover how you evaluate a company where the market outlook is so uncertain. My favorite part of this conversation may be getting some background as to the name of British American Tobacco. It's always one that has stood out to me. And the dynamics of international versus domestic are truly unique in this market. So a lot to consider here. Please enjoy this breakdown of British American Tobacco. All right, Evan, I'm excited. We are finally breaking down British American Tobacco. It's been a name on our wish list for quite a while, really since the beginning of Business Breakdown. So excited to get to it here. And I think we start at the top. It's a very obvious industry in terms of what tobacco is, but I think understanding who British American Tobacco is a good place to start. So maybe you could just walk us through what they're actually selling, what BTI is made up of, and anything else you think is really important to just have right off the top.
British American Tobacco is primarily selling tobacco, surprise, surprise. And they are roughly 50%, 50% US, a third Europe, and the rest Asia. And profits are probably a little bit more weighted towards the US. They have about 24 billion pounds of traditional tobacco sales. That's primarily cigarettes, also some cigars, also some chewing tobacco. And then they have 3 billion of what's called reduced risk or new category products, which are modern oral products, which are just a nicotine pouch that delivers the nicotine directly to your mouth. Vaping products, which people in the US are probably familiar with, and then a heated but not burned tobacco product as well, which is technically tobacco, but it's not burning the tobacco in your mouth. It's just heating it up just enough. And so within those 25 billion of traditional tobacco revenue, they have some pretty well-known brands, especially in the US. Most of the top brands that aren't Marlboro are British American brands. It's Newport, Camel, Kent, Dunhill, Pall Mall, Lucky Strike. Those are some of the main brands. And we'll get into the history, but a bunch of those they acquired via their acquisition of R.J. Reynolds. Between 2004 and 2017 is when they slowly consolidated control of R.J. Reynolds over time.
I knew we were going to get into that innovative product category, but just to hear the split of 24 versus 3 is interesting. And I can imagine which one's growing faster at this point. But let's get into that history a bit. From my sense of the research, looks like this has become a consolidated industry over the years, and you have major players. What does BTI look like basically start to finish? And maybe in the context of the industry as well, if you have any general market share numbers or anything you could share around that.
So the thing with tobacco is you have to go kind of back a long time. So British American was formed in 1901. I'm going to take us back to thousands of years BC, if you don't mind.
Oh, yes. We love history.
Yeah. So tobacco was used amongst Native American tribes, both North American and South American tribes, for thousands of years before Columbus got there. It was used for all sorts of different reasons. as various rituals, as like community building, just to get high, basically everything that you can think of that you might use a product like nicotine for. When Columbus first landed in the New World, he was actually given some dry tobacco leaf when he first got there as kind of like a present. So you can see how kind of important it was in some of those societies. But as far as the company and commercialization history is sort of European focused, that really started, especially in the colonies, with John Rolfe, who planted the first tobacco plant in Jamestown in 1612. And it sort of might be underappreciated how important that was for kind of the development of the colonies, because it turned Jamestown from a ragtag group of people who, like, in one year, only 40 people at Jamestown survived. But then with tobacco, it was turned into an actual, like, financially sustainable colony. And then basically tobacco was off to the races in the US, came side by side the slave trade as well over the next like couple hundred years. Then I'll fast forward us 250 years. The tobacco industry grew, primarily loose leaf tobacco sales. Chewing tobacco and pipe smoking were common. But then in 1880, a device was created called the Bonsack device, which took the production of cigarettes from a couple hundred per day to 70,000 per day. So it basically decreased the cost of producing these things by more than 50%. And the guy that bought the first machines decided, his name was Buck Duke, which just sounds like a guy from the 1800s. Of course, Buck Duke is going to try to create a tobacco monopoly, right? Like, it just sounds like what he would do, right? And he did it well. He bought these devices. He spent a bunch of money on advertising, which was an innovation back at that time, creating some of the first early brands. And in 1889, he formed something called the American Tobacco Company, which was essentially a monopoly on tobacco production and sale in the US. You'll notice we're getting kind of close to 1901 or 1902 when BAT was created. And so in 1901, this guy, Buck Duke, decided he was going to take his business and try to go compete with the British manufacturers in England. And they didn't like that, unsurprisingly. So they kind of circled the wagons, and 13 British companies formed what's still known as Imperial Tobacco. And they decided to fight off ATC from the US in every way possible by pressuring UK retailers not to sell their stuff. They actually came over to the US and tried to start buying stuff in the US just to like mess with them on their home turf. And they spent a year doing that. And then pretty quickly they decided, you know what, instead of fighting each other, let's just agree to have our own monopolies on our own domestic turf, and then create a third business, a joint venture that would sell our products overseas. And that was British American Tobacco. So you can kind of understand now where the name comes from. It literally was American Tobacco and Imperial Tobacco creating a combined company. For a long time, British American Tobacco was their thing. They were selling Imperial and American Tobacco brands overseas. And it took them a few decades before they started to get back into, they're still not a major player in the British market, but over time they did enter the US market. And they did that by buying a company called Brown and Williamson. I think that was in the 60s or 70s. But by then, the US had become a more competitive market because in 1911, the Supreme Court ruled that American tobacco was an illegal monopoly and broke it up into 3 different companies.
The lesser discussed, of the Standard Oil versus the American Tobacco.
It wasn't the first company that this happened to, but they had this playbook for kind of breaking things into its parts. American Tobacco was founded in 1889, and the Sherman Antitrust Act was passed in 1890. So I don't think that was a coincidence. But over the decades, in the US, you had various brands that were introduced. One of the first successful brands was introduced by R.J. Reynolds, would later become owned by British American, and that was Camel in 1913, which was like one of the first national brands. So over time, R.J. Reynolds and then later Philip Morris became like really strong competitors and came to dominate and do really well in the US market. They began to navigate a sort of increasing regulatory environment because in the 1950s, a bunch of studies came out, and that was also when the Surgeon General first sort of declared that there was this strong correlation with lung cancer that these companies needed to worry about. It was at that time in the 1950s that Marlboro decided to switch from being a women's focused brand to being a men's cowboy brand. And obviously that is like a case study in itself of sort of marketing prowess. In 1972, Philip Morris became the largest tobacco company in the US. But basically, the 80s and 90s were decades of BAT, but mostly RJ Reynolds consolidating the US industry, the non-Philip Morris US industry. You had the merge with American Tobacco in, I think, 1994. You had the merge with Brown and Williamson in 2004. You had them buy Lorillard, which made Newport in 2014. And so increasingly, RJ Reynolds sort of gobbled up these second and third players. And meanwhile, British American, based on the deal to merge with Brown and Williamson in 2004, they owned 42% of that company. So this was largely driven by BAT kind of strategy. They didn't technically control the business. Obviously, if you own 42% of something, you have a big say in what goes on. And then finally, in 2017, they pulled the trigger to buy the rest of it. So BAT took on a big chunk of debt to do that, but then they basically became the very strong number 2 player in the US, number 2 to Altria, which is, and there's just so many company names and mergers and acquisitions. It's just so complicated. But Altria is the company that took over the Marlboro brand, because after the US really started cracking down from a regulatory standpoint, Philip Morris split into Philip Morris International and Altria, which kept the Marlboro brand and other lesser Philip Morris brands. Part of that, I should mention, was the 1998 master agreement, where the big manufacturers agreed to pay $200 billion over 25 years to the states. I think that continues to this day. $9 billion a year or something is paid out as part of this agreement. One of the big changes that agreement resulted in was the split off of Philip Morris. So today you have, from a combustibles standpoint, you have still Altria as the number 1 US company, and then a strong number 2 is BAT. And Philip Morris is the biggest competitor elsewhere, and certainly in terms of next generation products. Their IQOS brand is the largest, and actually recently passed Marlboro for them as their largest brand.
There was a lot of interesting dynamics there that I want to hit on in terms of branding when it comes to these companies at the highest of level, but also the individual brands as well. But one thing that you mentioned throughout that history was the involvement of government, the involvement of regulation, a few key milestones there in that history. Can you just give us a sense of what the industry looks like in terms of regulation today, whether it's the taxing, the limitations on advertising, anything else that you can point to, because it's a much different playing field when it comes to tobacco products versus others?
The biggest thing is the companies are basically not allowed to advertise in the US or in most developed countries, whether that's on TV or radio or print or really anywhere. They're really banned from advertising. In some ways, that creates sort of a stagnation amongst these brands, which from a business perspective, think, well, stagnation might not be such a great thing, but stagnation, if you're the number 1 or number 2 company, is not such a bad thing, right? Because it's basically a guarantee that there won't be upstarts trying to break into this industry. The idea of trying to create a new cigarette brand, I mean, I would guess you'd get laughed out of a room if you tried to pitch that to a venture capitalist, because it's just such an obviously terrible idea. You can't advertise the declining population of users. There's going to be all sorts of pushback. And so it's just simply not possible. And it is taxed very heavily, primarily by the states, at least in the US. And of course, internationally, there's various tax regimes internationally, but like a big chunk of the price that you actually pay for a pack of cigarettes at the store is actually tax money.
I read somewhere, I think the industry was 800 billion-ish within the past few years in terms of total market size, and 25% of that was going to taxes. So immediately out the door.
Yeah, that sounds about right.
Quite a unique dynamic when it comes to operating a business. On the market size and just some of the trends that you mentioned there in terms of people that actually buy cigarettes today, it's a much different era than what it was like when actors and actresses were seen everywhere with cigarettes in their hand. It was almost a status symbol, in addition to the product being hard to quit. What has that trended like in recent years? And you can split that up however you like. If you want to mention what the new products are doing in terms of total market size, but how has that market size trended, especially recently?
The thing that we have the best data on, and also probably the most interesting dynamics, is probably the US. Historically, for British American, what they've seen the past probably 5 to 10 years on average is low single-digit declines in volume and roughly similar net price increases in terms of price per pack, which is a very convenient way to think about the business. And it ends up that the traditional business has been amazingly flat the last few years, although 2023 was actually a larger down year than some of the past ones in terms of volumes, with volumes down roughly 10% in the US. But prior to that, 2, 3, 4% volume declines were common. And it was actually not difficult for them because of this kind of dynamic of it really being an oligopoly, a lot of brand loyalty. They're historically able to raise prices to kind of offset that pretty easily. Altria had a slide recently that they presented at a conference that showed that they think in terms of the volume of cigarette equivalent packs, if you include basically all forms of nicotine, has actually been growing 1% per year over the past 5 years, because you have this dynamic where the traditional volume is declining, but increasing number of people are using vapes or using nicotine pouches or using some other form of oral tobacco. On their numbers, they have a 1% actually growth in volumes in the US. It gets even trickier, though, to actually figure out what's going on, because around 50% of the volume in vapes is disposable, non-FDA approved vapes that aren't tracked so easily. Like if Nielsen comes in and says, hey, how many of these vapes did you sell? At that point, they definitely know that they're not supposed to give them data. It's a little bit tricky to figure out exactly what's going on, but rough numbers, it's sort of low. It seems like it's either flat to slightly increasing overall volume, with the traditional combustible products falling low single digits. Elsewhere, it seems like it's outside of the US, except for a few places, there hasn't been quite as quick of an uptake on vaping, for example. And so in a lot of places, volume is kind of flattish, and price increases there can result in actually revenue increases. One other interesting market to talk about is Japan, because there you've actually seen almost 30% of revenues now are coming from next generation, these heated but not burned products, primarily IQOS. And that market, the overall market has been growing very low single digits, but the overall market has been growing. That's like another story that I think eventually is going to be told and people are going to realize, is that as people move to less harmful products, the market may actually grow.
We have yet to mention the name Zyn. We've alluded to the pouches, and I know Zyn is not a British American Tobacco brand. Certainly all of the craze and media headlines, and there's some similarities to what was happening with vaping years ago. But when you frame the actual market sizes or market share split between that traditional tobacco and the new wave of products, you gave some sense for BTI. Do you have a sense for the market overall? Are they a reasonable proxy in terms of their mix?
It kind of depends on exactly what you mean. For everyone except for Philip Morris, they have the highest penetration of, I think it was like 16 or 17% in 2023. It's going to be like probably more than 20% this year in terms of next generation products. And for everyone except Philip Morris, that's a very high number. I think Philip Morris is roughly 30% of next generation products and going towards 40%. That's sort of ex-China, I think, because China has a huge industry and I don't think they have any significant next generation, although some of the companies that manufacture these things are actually in Hong Kong, which is kind of ironic. But yeah, Japan is like almost 30% share. Europe, it's much lower. In the US and other places, it's 10, 15, 20%. I think Zyn is a super interesting case study. I mean, Philip Morris is guiding for 60% volume growth. And I think what people are discovering is that obviously people have known for thousands of years that nicotine is kind of an enjoyable drug to consume. And what the companies are realizing is that if people can do it in a way that's less harmful, there's just going to be much more demand. So I think that might be the canary in the coal mine for kind of the long-term growth of the industry. And BAT's Zyn-like brand in Europe, which is Velo, grew 35% last year. And I think it has a good chance to continue on sort of a Zyn-like trajectory across Europe and maybe eventually the US. They have a Velo 2.0 product that they're going to be launching in the US at some point once it gets approved, but it's not approved yet.
With something like pouches, it's something where, almost 20 years ago at college, I would go to a party and there would be some rep from a tobacco company giving out these pouches for free. So they were around then. Can you point to what has actually led to the inflection of interest and the demand?
I think it's a combination of things. I think one is back in the day, back when we were in college, the modern oral products had not been released. So there was like snus products that were basically pouched tobacco products. Actually, within tobacco products, there are cancer-causing chemicals. It's not just burning it in your mouth. They're called tobacco-specific nitrosamines. I hope I'm pronouncing that right. And while it's definitely a lower risk product for sure relative to inhaling a bunch of smoke, there is definitely risk there. A lot of that risk, I think, goes out the window with the modern products, which are just pure nicotine in a pouch. And most of those did not get released until around 10 years ago. So there was that. And then I think also similar to the popularity of vaping in the US, once you have a product that is a purified nicotine, it's not tobacco, so it doesn't have inherently any sort of tobacco flavor, you can put other flavors in it. So you can have a mango Zyn or a mint Zyn or whatever. And that's just, I think, inherently a more desirable product than a tobacco flavored pouch. So I think it was a combination of those things, the health aspects and the ability to more easily put in flavors that probably is causing the growth in the business.
And then in terms of those products and the regulation around those, it's interesting because it seemed like Zyn was an upstart or part of a much smaller company before being acquired, which shows that there can be this path for new products outside of the traditional cigarette space. Are they regulated significantly differently in terms of whether you can advertise for them or anything else along those lines?
Zyn is basically regulated similarly to any other tobacco or nicotine products. They're not allowed to advertise. They're not allowed to do all the things that a normal company could do in terms of marketing the products, which honestly makes its growth all the more amazing. It's not even fully approved, actually, in the US. There's sort of like two buckets of these reduced risk products, or it's actually three buckets. One bucket is actually approved products, which I think Vuse, Enjoy, and self-serve e-liquid products where you have your own personal tank and you refill it, et cetera, which is like a tiny percentage of the market. Those products are like actually approved. And then there's a chunk of products where they are not approved, but they're still in litigation and the courts have said that it's okay for them to be sold. Zyn is one of those. And then there's a whole group of products that are like actually not approved and not under any type of holding pattern where they're still allowed to be sold. That applies to like pretty much all of the disposable vaping products in the US.
Are there limits on distribution as well? Because when I think of where you can actually buy cigarettes, gas stations and airports, duty-free areas, are there other key distribution points for these businesses?
I think as far as I know, you just have to, the retailers have to be licensed, and typically, so the regulations are basically similar to traditional tobacco products. You have to have like a license to actually sell it. Arguably, the distribution prowess of Philip Morris is what some people point to as sort of fueling the growth of Zyn in the US over the last few years.
Getting to the point of brand, which you mentioned, there's a lot of brand loyalty from centuries ago. You mentioned names like Camel and Marlboro. But when you flash forward to today, when you have a product like a Zyn and you're trying to compete with that and the media coverage that it's getting, which is in some ways likely to just attract more attention potential users unless there's actually regulation enforced, how does a business like British American Tobacco try to get more loyalty towards their own brands and their own products?
In the US, they've had a really tough time breaking into Zin's stranglehold on the US market. And if anything, when people ask, because sometimes there's some pushback around sort of the brand loyalty of vaping, for example, people think that people will just use whatever product. But if you look at Zyn, I think what Zyn shows is that once brands are well established and people start using the same thing and they like it, it's actually pretty tough to break into that stranglehold. And so what British American Tobacco has done so far is actually refocused on the markets where they're the Zyn, which is most of Europe that has sort of a material modern oral business. They're by far dominant in the Scandinavian countries, for example, which is where the product originated. I don't think they've explicitly said this, but I think that they're waiting for the approval of their Velo 2.0 products in the US before they really put marketing dollars behind it, because that's the product that they're selling in Europe. That's the best product. And so they had the Velo 1.0 here, but not the 2.0. And so I've actually heard of Canadian hockey players that import this Velo 2.0 product from Europe. They like it better than Zyn, supposedly. And that might just be me searching for a sign of an anecdote that matches my bias. I think it's a good sign for the long-term ability to compete.
That anecdote, I think, is just interesting in this day and age in terms of who influences the purchase of things, and avoiding the word influencer, particularly in an industry where advertising is difficult. You did mention the distinction there that they would spend marketing dollars. Can you just differentiate what marketing dollars mean when advertising is so restricted?
It's primarily in discounts to retailers. You can also put people out into the field. You can put physical bodies out there to carry packs of Velo and say, go to convenience stores and say, hey, you should be selling this, that have better product placement, etc. You can have them put something in the window of the convenience store or whatever. You can pay for that type of advertising. That's common. Almost giving the retailers free product is one of the common ways that they spend marketing dollars.
There's an interesting category of businesses where I think you see the reps on the field. Again, I'm going to bring up the college party example where Red Bulls and pouches were not too uncommon to see out there.
In Europe, what IQOS did, which was genius, was they would have sponsored events. I think they still weren't allowed to do traditional advertising in many places, but they would sponsor events. They would lease these retail spaces where it would be almost like an Apple store to get people to come in and try the thing. No one in the US has tried anything like that. With the success of Zyn, it doesn't seem like it's necessary, probably.
I want to transition a bit into the financial model of this business. I think we've touched on a few of the dynamics with the top line and whether that's flat because it's neutralized by price and volume, or maybe steady growth, slight incremental growth in the future. We hit on the tax that is very common on these businesses. But just if you step back and look at the overall margin profile of this business, what does that look like and where has that trended over time?
The margin profile of the business is remarkably stable. That's one of the nice things about these tobacco businesses. On a gross margin basis, the company basically has been making, in 2013, they were at a 78% gross margin. And in 2024, it's going to be an 83% gross margin. And in terms of operating margin, it's basically been around 40% for a really long time. That's one of the attractive things about these businesses is that the margins are super stable. Obviously, the customer base is coming back with sort of a daily consumption product. And the combination is a business that just throws off cash and can use that to pay dividends and buy back shares and do all the rest.
One of the most commonly referenced things with investors is the free cash flow yield. Can you talk a little bit about earnings conversion in terms of how much is actually dropping through to free cash flow?
One of the great things about the tobacco businesses is that they don't require a ton of capital to grow or to sustain itself. So with British American, this is a company that did $9.2 billion of operating cash flow last year and only required $500 million of CapEx. So what that means is basically all of the $8 billion of income is falling to free cash flow. And so what that does is it allows them to pay down debt because they bought RJ Reynolds in 2017, and at that time they had $50 billion of debt. So they've been slowly paying that down. But then primarily they pay a gigantic dividend. So last year they paid out $5 billion of dividends, which on the stock price, I mean, for a $50 billion market cap, that's basically going to be a 10% yield this year. And contrast to a lot of 10% yielding companies, this is not like some oil driller that's paying you out the last drops of profit before the futures curve collapses or whatever. This is what I think is probably going to be a stable to slowly growing business that just has a 10% dividend yield.
Not a cigar butt.
Exactly.
Sure, it's not the first time that has.
I actually had not made that connection. That's interesting. Yeah.
I think it's a name that you often hear from investors as screening attractive from a valuation standpoint. They have the free cash flow yield. There's been a steadiness in terms of the actual earnings stream as well, but it hasn't quite responded to any of that. So I think it gets this designation of as a value trap. Are there catalysts that you see that could unlock a change in the actual perception of the stock or investment of the stock or stock performance?
The first thing to understand is I think the valuation itself, actually at this point in 2017, it traded at 15, 16, 17 times earnings. The valuation can decline at that point. But from 6 times earnings, 6 times free cash flow, it's just a lot harder for it to decline, I think. That's the first thing. The second thing is that honestly, the dividends and the growth in the dividend can just create its own return at this point. I don't necessarily agree with him on all that much, but this is something that David Einhorn was talking about recently and how he views some of the stocks that he holds. It's a great way to just have your downside protected because you can just collect a 10% dividend that's probably going to grow, in which case you're going to earn a double-digit return and then some. The biggest thing is as people start to realize that these tobacco companies, they're not melting ice cubes anymore because they have this business which is going to replace all of the traditional tobacco revenue that they're going to generate. I mean, it's going to take years. It's going to take 10 years to get to 50% of revenue, but it's going to happen. As they start to realize that, and that it's going to be the case for BAT, I think there's a good chance that the stock could re-rate. And then you're talking about taking a 10% plus return into, could be anything. It just depends on what time frame you're talking about. But if you look at Philip Morris, I mean, Philip Morris trades for like 14 times, and Philip Morris might even be cheap. And Philip Morris trades for 14 times earnings. I mean, if BAT traded for 14 times earnings, it would have to more than double. So that's kind of the third potential, is that as people kind of realize that not only is it not a melting ice cube anymore, it really shouldn't be viewed as such a negative ESG company. Full stop. Traditional products do still kill people. But there's something to be said for a company where all of the future efforts are going towards switching people off of that product and onto something that's way less harmful. And it's not because it's the goodness of their heart. They're just trying to make money and protect themselves for the long term. But I think there's a chance that it results in a change in perception in the market. And then actually the fourth thing is once reduced risk products really take off, like we're seeing Zyn in the US, the market overall may grow. Because if these products are really 90 to 95 to whatever percent less harmful than traditional cigarettes, you're left with a drug that has some interesting properties and might be just like caffeine, where like a huge chunk of the people take it. I mean, think about the fact that after World War II in the US, 50% of people smoked. In the UK, 80% of men smoked. I don't necessarily know that I want to go back to a world where 80% of people are taking nicotine, but it's certainly plausible in my view over a long enough period of time.
Yeah, there's a lot of interesting parallels when you look at, as you mentioned, caffeine, to the other extent, alcohol. We have legalization of cannabis, all different properties, all different addictive traits in them, all different health concerns. So there's other industries that you can look at, but at least from my perspective, it feels like these brands have the most negative, visceral association with them today.
In the UK, I don't know if they've done this survey in the US. I think in the UK, 80% of people still think that nicotine is the primary cancer health problem causing agent in tobacco, despite the fact that that's pretty settled science that it's not the case.
Just from your sense of talking to other investors, as you mentioned, whether it's ESG or just funds out of principle not wanting to own this type of product, do you have a sense of how big that represents in the market? Like how many buyers just have ruled themselves out?
What I think you find, it's just in the world in general, but especially in investing, is market prices are kind of dominated by the largest players, how they feel. And I think if you look at a lot of the largest investment businesses in Europe, and certainly pension funds and everyone in Europe is like really devoted to ESG. And there's a lot of great causes behind ESG, but I don't know if divesting tobacco is going to remain at the top of the ESG list in 10 to 15 years. And I don't think it helps BAT actually that its primary trading ticker is in London as opposed to Philip Morris, where the primary trading ticker is in the US. So it's kind of weird that the international business trades in the US, that trades at 14 times earnings. It's kind of an interesting dichotomy, which can partly be explained by Philip Morris's how much further they are down the road of the journey toward reduced risk products. But I think part of it's probably also explained by European investors' like stronger focus on ESG and related shunning of tobacco stocks.
One of the points on capital allocation, which we didn't hit on, was the M&A activity, which historically there's been a lot of acquisitions. I think there's something interesting about Zyn being an upstart, them being acquired. I think of parallels to something like cosmetics, where L'Oreal and some of the bigger players can buy up these upstarts that have this success before they get too big. Is that something that you expect to continue in the future as part of the thesis in one direction or the other? Is M&A activity something that you expect to happen on the horizon?
I don't. I do not. I think that for the most part, these companies have really gobbled up everything that could really move the needle and also be regulatorily approved. I think Philip Morris got an amazing deal, as it turns out, with Swedish Match. They paid what was like a premium to traditional tobacco multiples, but really did not compensate them for the growth that they were going to see in the Zyn business. I think they would pay many more multiples now. They paid 22 times EBITDA, but they were sitting on a rocket ship, basically. I don't expect it to be a big part. It's possible we could see upstarts. It kind of revolves around the regulatory structure, honestly. In a world where any type of disposable vape can be sold on stores, and there are upstarts all the time. There's brands changing left and right. But in a world where you actually need FDA or other regulatory, whatever country approval to sell a nicotine product, which is the world I think we're moving towards slowly, I think it's going to continue to be dominated by the companies that have the money and the time and the regulatory prowess to actually navigate that. Like, I think it's telling that Vuse is one of the only actually approved products in the US. At this point, like, the FDA is its own monster. I don't think the FDA knows that its policies have over time. I mean, it's not just the FDA, right? It's like the advertising bans and all these things. I don't know if people really understand how much it entrenched the existing tobacco companies and kind of benefited them, but it's just kind of part of the deal with this level of regulation.
Yeah, regulatory capture in its way. And when you think about other industries, something like cannabis, which I mentioned before, is there any possibility that there's an extension into cannabis?
BAT has made, I think, a couple £100 million investment into a Canadian, basically like almost penny stock now, Canadian publicly traded cannabis company. You can close your eyes and imagine a world where the distribution and regulatory prowess and all that allows them to add value to a cannabis company and potentially like try to acquire one. Any type of profitability in that business seems likely to be a rounding error on any of BAT's business. I mean, it took decades for most of the cigarette brands to kind of be developed. And so I think probably cannabis might be similar, but we'll see. I'm not holding my breath.
I think we've touched on most of the risks. There's just the obvious industry in general and trend lines that have been happening over a long time there. Is there anything else we haven't touched on that you think is important to note?
Yeah, there is actually. The major risk that we haven't touched on is the potential for menthol cigarettes to get banned in the US. So British American, when they bought Reynolds had to divest the Cool brand of menthol cigarettes, Imperial, when they acquired Lorillard. But the Newport Lorillard brand, which is the largest, came in to British American's business when they finally acquired R.J. Reynolds. And to this day, menthol cigarettes in the US are a huge percentage of their business. It's like on the order of 40-50% of the US combustibles business. And that means it's, around a quarter of their revenue. Let's take a step back. So the reason why that matters is because the FDA under the Biden administration has made a bunch of noise about banning menthol cigarettes entirely across the US. Now, this is a little bit controversial, would definitely get caught up in a legal battle for years if it did come to pass. It's a big risk for them because, we think that some consumers would probably stick with their brand in a non-menthol version, but some consumers are going to choose another brand. Some consumers are going to quit smoking. One upside could be that some consumers will choose one of BAT's vaping brands because they're the largest vape brand in the US, so that would make sense. But net, we think that they could lose 10 to 15% of their profits on a menthol ban in the US, which is a lot, $1 billion basically of profit. Now, I think at 6 times earnings for a business that's otherwise going to grow, we think low single digits, that's baked in already. And when you kind of multiply that on an expected value basis by the percentage chance that either Trump wins the election, and I don't think they care about this, or Biden decides not to do it for whatever reason, I think it's a risk that's well baked into the price, but it is a risk, definitely.
One thing you mentioned there, which I wanted to touch on earlier, was the vaping phenomenon, which felt like it was really powerful 5-ish, maybe a little bit longer than that years ago. But the craze seemed to have died down. And I don't know if that's been reflected in the numbers as well. But can you point to anything just about that real euphoria run-up around vaping?
I think because it was starting from nothing and the percentage change was just so huge that it really kind of took the world by storm. It was also underregulated. All of a sudden, Juul was everywhere. And they had all these flavors and kids are smoking it. And you can go watch the Netflix documentary on Juul. And kids are talking about how they got addicted in high school and they didn't know that it had nicotine in it. They thought it was just air. And that is so crazy to me now. And I think probably high school kids are, unfortunately, some of them are still vaping, but I think they know kind of what's going on now. But yeah, I think it was just such a big explosion from nothing that it seemed like it reached the airwaves and national news, et cetera, more quickly. But since then, the industry has continued to grow. The same chart that Altria put up, you have a steady 16 billion pack equivalents in the US in the overall sort of nicotine market. But you basically have the the vapor market growing by 5x since 2018, something like that, and like 20 or 30% last year. The problem is it's not all in channels that are like well tracked. So it's harder to kind of keep track of. Whereas when it was just Juul, Altria was invested in Juul. Like we kind of knew what was going on with Juul, but whereas with these Chinese companies selling disposables, it's a little bit more under the radar in terms of business news, but it's still growing very strongly, like 20, 30% in the US.
Good example of where my perception is not equivalent to reality there. Well, this has been an excellent conversation. We close these out with the lessons that you can apply elsewhere. What would you point to as just a lesson from diligence on British American Tobacco that you think is cross-applicable to other investment opportunities?
I think the biggest lesson I've learned from kind of studying British American Tobacco and investing in the company is to always look under the hood and make sure you really understand what's going on with the company, because a business might be flat at 26 or 27 billion of sales over a long period of time. And it might have a lot of shareholders complaining about why it's a value trap. But under the hood, a lot of people aren't paying attention to what's going on. And if you peel back the layers, then occasionally you can find a strong investment opportunity that's not reflected in the current share price. So the investing process is always a battle between how much time to spend on a given name and when to move on. And I think the lesson is you have to spend enough time to really figure out what's going on.
Good wisdom there, and I think completely appropriate. This has been an excellent conversation, Evan. Really appreciate you sharing the detailed history and bringing us up to today with just as much detail about the recent years. Thank you for coming on.
Thanks, Matt. Appreciate it.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JoinColossus.com.